Hi, I'm MJR Invests, and today I'll be sharing my successful way of identifying stocks. National and international media outlets such as the Financial Times, Motley Fool, the Metro, and the Express have asked for my opinion on how to become a stocks and shares ISA millionaire. Most people who are investing know what their target companies do, but how do you know if they're currently overpriced or if you're buying in at a good time? Today I will share my criteria on how I select stocks. Number one is to have a long-term vision. You need to determine whether the stock you are interested in will be around for the long term. And here I'm not talking about 3 months, I'm talking about 10 years and beyond. I've shared the importance of this in a previous video. Is the stock you're interested in going to be around for the next 10 to 30 years so that you can cash out and retire or live off the dividends? To do this, you just need to take a look around to see how the world is changing. For example, town centres are having a horrible time with lots of closed down shops. And this is because the world is going digital. But those digital assets will need to be protected. So rather than investing in short term stocks, such as shops and stores, why not think about stocks like cybersecurity and data management that'd be vital for the next 30 years? This should be your first criteria. Is there a market for this stock to grow into for the next 10 to 30 years? If the answer is no, then rule it out. And if yes, move on to criteria number two. Criteria number two is to have a good understanding of what the company does and how it will grow. This sounds simple, but is often overlooked as people typically follow other people's opinions. Growth could be in things like product development, overseas expansion, or growing populations who require the product or service. I've produced detailed analysis on stocks such as Legal & General, National Grid, and Diageo, all of which highlight growth areas. If you'd like to understand how much of an understanding you should have in a company before executing a buy, then I'd highly recommend watching one of these videos. Once you have highlighted the company as a long-term vision with a clear growth path, you can move on to criteria 3, assessing the first company fundamental, the PE ratio. This shows how much you are paying for a stock in terms of its earnings. It is calculated by dividing the share price by the earnings per share. The ratio is often used at face value to determine stock valuation and can be used to show how a stock's valuation compares to other companies in the area. The PE ratio indicates the amount an investor can expect to invest in a company to receive £1 of that company's earnings. For example, if a company is trading at a PE ratio of 10, the investor is willing to pay £10 for £1 of current earnings. Ideally, you also want to buy companies which are trading below their average PE ratio over the past 5 years. Otherwise, you may be overpaying. If a stock is trading at a ridiculously high PE ratio, such as over 50, then I often rule it out. The only exception is if the company is a new one with high growth aspects. The earnings may not be high at the start of a company's trajectory, which skews the PE ratio. However, although PE ratio is often used, no single ratio can tell you all you need to know about a stock. If the PE ratio is not ridiculously high, then I would move on to the next criteria, investigating the net income. To put it simply, I want to know if the company's net income is growing and by what percentage. Stagnant net income suggests the company either has a problem with its growth or it's spending too much on its costs. To work out the net income, I take the net income and subtract the old net income and then divide it by the starting net income. Then multiply this by 100 to get a percentage. Net income must be growing. The only exception to this is if the company is massively invested in research or some sort of construction cost over the last year that is affecting current net income but will produce growth in the long term. Using Legal & General as an example, the income statement on Yahoo Finance shows net income, and this is increasing year on year. The cash flow statement shows investments in infrastructure and acquisitions. Here, the investment is not too much relative to income, so I'd not say investment hampers net income. If you are confident that the income is reasonably growing, move on to the next criteria, total current assets versus total current liabilities. This one is very simple. You divide the total current assets by the total current liabilities. If this returns a value greater than 1, then the current assets outweigh the total current liabilities, and the company should be able to handle short-term problems like debt if needed. The final metric I use is the PEGI ratio. For this, I divide the PE ratio by the dividend yield plus the net income growth. This values a stock based on its earnings growth and dividend yield. Less than 1 suggests a stock is well priced, whereas anything above 1 suggests it may be overpriced. If a stock passes all of these checks, then I will always execute a buy order. I recently did this with Legal & General and have a full video analysing this stock. Of course, everyone has their own way of investing in stocks. This way has worked very well for me, earning an average 11% yearly return over the past 3 years, even though the stock market has had a rough time. Please feel free to comment your way of analysing stocks. as I'm always open to hearing new ideas. Thank you very much for watching, and please feel free to subscribe for more investment tips and tricks.